When we think about investing in dividends, it can be a very rewarding experience, but it also does come with some risks, which is what we're going to be covering in this video today. The 5 risks of investing in dividend ETFs and dividend stocks themselves. It's very important to know that with the dividend portfolio, there does come an inherent risk that a lot of people don't think about. You see all the videos, you see all the content, you see all the social media that talks about dividend investing, the dividend kings, all the money they make on dividends, but it does have a downside. Starting with number 1, dividend cut risk. This is really the biggest part of a dividend portfolio when companies are in financial distress, and we have seen this throughout time. When you think of Kmart, when you think of Toys R Us, when you look at some of the companies that had issues, first thing that is automatically cut is usually the dividends that they offer to investors. In that, they may cut or suspend dividends, meaning that there are not going to be any payments, which can be devastating if you are a dividend investor that is holding that in your portfolio, because you're relying on the growth of the stock and the dividends that they're giving you, and you will no longer receive that same level of income. Now, of course, investors of the companies, if you're investing in dividends, a lot of people will go ahead and sell. Not only that, it can drive down the sale price of the dividend stock or the dividend ETF itself, because there is the dividend cut. Number 2, we look at the dividend trap. This is another one. These are companies that pay out a high dividend when they are in financial trouble. Now, we have seen some of these. If you use M1 Finance down below, I have a link. But you can look at some of the companies that are paying exponentially 30, 40, 50% in dividends, which is kind of crazy. They really offer a very high dividend that is not attainable or is not sustainable to attract investors to bring money into the company. You have to do a lot of research, a lot of due diligence about the companies that are offering extraordinary dividends. When you think of some that have done it for a multitude of years, might be a little bit on a safer play. But if you have companies that are offering like these 10, 12, 15% dividends, chances are that is not sustainable, because essentially when the company is paying a dividend, they either have one of 2 options. Number 1, they're paying a dividend to their shareholders, they're giving money back to their investors. Or number 2, they have the ability to reinvest that money into the company, which could also result in growth. It could result in research and development. It could result in a stock, essentially the company doing and performing a lot better than it giving back to essentially the shareholders. Number 3, we look at the reinvestment risk. This is another one that you have to be very cautious about. For a lot of people who reinvest the dividends, you could see this when the dividends are paid. The investor has the choice of taking the money or reinvesting the money into a company's stock. While reinvesting is a great way to build up the compounding of interest, there can also be a downside, because if the stock price starts to drop or the dividends start to be cut, your money is all tied up into one place. This is the reason, again, to really mitigate the risk, diversifying the portfolio, a bunch of different stocks, a lot of different dividend stocks, or looking at those single ETFs that are managed. Some of them managed, some of them are not managed. Again, do your research when it comes to those ETFs and when it comes to dividend investing. And guys, we just monetized the channel, so big shout out to all of the subscribers and the viewers. Let me know in the comments what you guys think. Click the like button, give it a thumbs up. Let me know again what you guys think. Sub to the channel, we are getting there. Number 4, we look at the tax risk. A lot of people never realize this when it comes to dividend investing. Depending on the type of dividend that the company is offering, you could be subject to different taxes at different tax rates. Qualified dividends are taxed at a lower rate than non-qualified dividends, which come as qualified or regular income. So if you're thinking of your regular tax bracket, let's say you're taxed at a 24% bracket, you're getting non-qualified dividends, which are coming as regular income. You're going to get 24% of that literally taken off the top, because it is coming at regular income. If that is where you're going above and beyond, consult with your tax advisor before you set up a portfolio, because essentially when you start getting into higher numbers, when you start getting into exponential growth, when you're looking at, 100,000, 200,000, 500,000, this could be an absolute game changer, launching you into much higher tax brackets, just based on the dividends that you're getting, and also knowing what companies are paying and how they're paying it. Now, one thing also to remember is when it comes to federal funds, or when it comes to federal, state, and municipal bonds, which a lot of people like, they do have a little bit of a higher yield. However, these bonds, for the most part, are completely tax-free. That's right. So you have to think exactly what you're paying on the dividend side, if you're paying dividends, or if you're paying taxes on your dividends, apart from what government bonds, the federal, state, and the municipal bonds are paying, that are completely tax-free. Have to really run the math in a bunch of different scenarios and see exactly if it does make sense to invest in something that offers a little bit of a lower yield, but does have that tax advantage. Very important to understand the tax implications before you start putting it into a heavy dividend portfolio. Then, of course, number 5, which we're understanding and seeing right now, is the market risk. There is a high market risk when it comes to a lot of stocks. Dividend stocks tend to be a little bit more volatile than any other type of investment. And of course, this can be a major problem for investors who are not willing to emotionally buy or tie in to the market's ups and downs. Reducing the risk, of course, portfolios across different industries, different sectors, and not investing into single stocks or not putting too much of the portfolio into a single stock. I've seen a couple of individuals that are investing in a single stock or even 1 or 2 stocks that offer a good yield. Unfortunately, the stock price is either stagnant or the stock price has actually dropped, meaning that you're not getting quite the yield that you thought you would be getting, because overall the growth is not there. Even though you're getting a good dividend, the growth of the stock is either declining or we're not seeing any exponential growth, or it's not growing at all. Investing in dividends is a great way to generate passive income. We did the video before growing a $1.1 million portfolio, putting it into dividend ETFs, making $50,000 a year, which is kind of crazy, but it's important to really understand the risk. And that is why I stay with the ETFs. Be aware of the 5 financial or the potential risks that we talked about today before you get into the investing. Understanding managing these risks can make a really big difference. But like I've said before, I invest in ETFs, and I have said this from the beginning, guys. ETFs for me have always been the way to go. This, of course, mitigates your risk automatically. When you think of a dividend portfolio where you might hold, 3, 5, 10 different companies, depending on the percentage you're holding can make a really big difference. But if you're investing in 1 or 2 ETFs, mainly if you look at like the Vanguard High Yield Dividend, if you're looking at the SCHD, which is a pretty good income fund, there are a lot out there that are across markets that literally have hundreds and hundreds of companies in their portfolio. That is why I stress when it comes to ETFs, really the risk mitigation factor that you have in there is a game changer. It is an absolute game changer, because essentially, if you have a company that is underperforming, if the dividends are pulled down, they're going to systematically, during the rebalance every year, the SCHD will get rid of the company that is underperforming and replace it with another company that they think is going to do exceptional or that is paying dividends. Or some of these companies have been paying dividends for a multitude of years. Some are talking 20, 30, 50, 75, 100 years of dividends, and dividends have increased over time, meaning that exponentially they have seen growth. And looking some of the staples like 3M, Coca-Cola, there are a lot of individual stocks, which again, you have to take it with a grain of salt and know exactly what you're investing in and what percentage of your portfolio is going to be in that dividend stocks. That way you can generate the income. So, all right, guys, that is going to do it for the 5 risks of investing in dividends, and I'll catch you in the next video.